You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by SWAN Global Investments. Since 1997, SWAN has been the leader in hedged equity and option income strategies with GIPS verified results. SWAN provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, SWAN defined risk mutual funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think SWAN when deciding on risk management solutions to market risk. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the CBOE over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody, that music means it is time once again for the Advisor's Option, the program for you, the busy financial advisor or asset manager who's maybe considering dipping his client's toes into the options waters. Maybe you're a client and you're wondering what your advisor should bring to the table from that perspective. Either way, we got you covered. My name is Mark Longo from theoptionsinsider.com, as well as, of course, in this fun network upon which you are consuming this program. Hopefully you're not just listening to the Advisor's Option, checking out all the other pretty much dozen programs we do here on this network. Multiple times a day, content's hitting you. So wherever you listen to this, make sure you subscribe to the full network. And if you like what you hear, leave a comment, leave a review so other folks can continue to discover this fine program in these troubled times. And joining me to help produce this fine program, first off, let's go out to the sleepy state of New Hampshire, where we are joined once again by Mr. Matt Amberson, the founder over there at ORATS and the keeper of all the cool earnings data we like to analyze here at the Options Insider. Mr. Matt, welcome back to the program, sir.
Thanks, Mark. Trade free or die.
Yes, that should be, you guys considering updating the state motto these days?
That's what we do here. So ORATS is proud to have our headquarters in Portsmouth, which is a beautiful seaside community here, and things are going well for ORATS.
You have New Hampshire, brought to you by Robinhood, trade free or die. That's perfect. It fits right in with their founding ethos over there. Now we're going to dial that clock all the way out to the southeast portion of the Atlantic here, where thankfully he's been dodged by 2 hurricanes at this point now, at least just in the last couple of weeks. So he's joining us once again. No hurricane delay this month, thankfully, by Mr. Chris Hausman, the portfolio manager. Most of you know him as the director of risk over there at SWAN Global Investments. Mr. Risk Director, welcome back to the program. How goes hurricane season, sir?
It goes. It's been very interesting, and unfortunately, there's 3 more months left of this, so we'll see what happens. But nevertheless, good to be back on the show with you guys.
Isn't that the most 2020 thing possible, where we effectively had double hurricanes in the Gulf at the same time? Something that's never before happened. But of course, 2020, why not?
This year's fat tails are fatter than fat.
Yes. Well said, to put it in the parlance of the show, sir. And then dialing the handle again, usually to Florida, but I think he's on vacation right now, so I don't know where he is. Let's find out. He is Mr. Eric COTT, the Director of Advisor Education over there at the Options Industry Council. Mr. COTT, welcome back to the program, and where are you hanging your hat these days, sir?
Well, it's always good to be back here, Mark, and I wouldn't miss the opportunity to be with my friends Matt and Chris. I am still in Florida, and as Chris had alluded to, we're still not out of the woods. It's just the start of this volatile, tumultuous weather pattern that we have, sort of analogous to the, increase in VIX 6 months ago. And now what we're seeing is volatility in the Atlantic, volatility in the Gulf. We've got, unfortunately, to our brethren, Mark, in the West Coast, the fires out there in the West Coast. I mean, it's a catastrophic weather pattern going on in the United States. And we're obviously going to talk about volatility in the market and advisors, but people are mostly, again, our colleagues down in the southeast quadrant right now in Louisiana and Texas, we send our concern and hope everything's okay there.
All right. With those thoughts sent out, let's keep on rolling right on into the buzz.
Busy financial advisors and asset managers don't have time to follow the latest developments from the world of options, so we do it for you. It's time to get the buzz.
All right, everybody. Welcome to The Buzz, a portion of the show where we help you, that busy financial advisor out there, probably doesn't have time to keep up with all the comings and goings in the world of options and derivatives because you're busy keeping up with your clients. That's a full-time job, especially these days. So we're going to do it for you. But before we do that, these markets, these times are so unprecedented, I think, to misquote the director of risk, the fat tails of 2020. Fatter than ever before. An interesting time. So we like to kick off the buzz, kind of getting everyone's thoughts on exactly what we're seeing in these tumultuous markets. And here we are coming into the show where yet again we have a period of protracted rallies in the broad equities. And I've been saying this for a while now. It seems like the equity market kind of whistling past the graveyard in terms of all things pandemic and disease and everything else going on here in the U.S., civil unrest and everything else going on. The market, if you look at it, is already pricing well beyond this at this point. So a lot to unpack. Let's go around the horn the way we started. Let's go out to the land of ORATS first. Mr. Matt, a lot to unpack. What is lighting up your tape? What's on your radar? What are you making of these yet again tumultuous markets, mostly rallying, and vol coming in a bit since our last show, sir?
Yeah, so just to take it back a little bit, I'm looking at this long-term graph on the ORAT site, our new charting package. And back in almost a year ago, I was at a OCC event out in Texas with one of the colleagues of Eric. And, we looked at our crystal ball and we looked at the volatility and it looked pretty nice. And so we were a little bullish there. We had then the implied volatility just kind of resting and even dropping a little bit. contango, which is the front month volatility. And I usually just look at SPY. I know that a lot of people look at the VIX, but just in SPY and in SPX, the contango was healthy for a bullish market with the front months and underneath the back months. And historical volatility was low. Contrast that in the weeks before I made the call on this show when volatility started really popped a few months before the tumultuous COVID market. We suggested some risk off, and that came to pass. And then recently, these last few months, the volatility is just barely going down, very slowly. That's bullish for the market. Obviously not good for option holders. We'll talk about earnings later. That was actually a lot quieter than most of us expected. I got the 20-day historical volatility at 11.6 in SPY and the implied volatility at 16. So it's coming down to levels, pre-COVID. So it's a market that looks pretty tame right now, Mark. I never thought I'd say that this close to COVID, but that's what it's looking like.
I think we can say that for pretty much every episode we've done so far this year. I never thought I would say this, but something unprecedented would come out of our mouths next. That's pretty much been the case since January. Remember, we kicked this year off with some assassinations in the Middle East, and it kind of just went downhill from there. Oh, how distant that seems now, that January show in the rear view mirror. Mr. Chris, a.k.a. the Director of Risk, same question for you, sir. You mentioned those fat tails out there in 2020 being fatter than usual. Kind of hard to argue with that. What else is catching your eye? What else is lighting up your tape in these somewhat unprecedented times, sir?
Yeah, we're really in an environment of spot up, vol up. And what that means is, volatility consists of three different things, right? The direction of the marketplace, the speed of movement, and the magnitude of the movement. And one of the questions we keep fielding is, the markets have been rallying, but VIX hasn't really been coming in that much. It's softened a little bit, like we just mentioned. But for the most part, we're in no man's land. And so what's happening is all the volatility curves are repricing themselves. And so the lingo really is spot up, vol up. And it kind of takes people aback a little bit because it's new for most people that get into the volatility game. And what you're seeing right now is historical or realized vol. If you look at 5-day and 10-day, you're flirting in the 5, 6, and 7 handle, but you still have a VIX that's 20 plus. So in other words, the risk premium is very, very healthy right now, kind of just jumping on what Matt said, but it's overpriced. And it's overpriced because there's this dislocation that's being caused with the election. And the VIX really should be about 15 to 18 right now. So something's going to give once the election passes and we know who the next president is. And going back to the term structure, if you look at the term structure, it's very unique. We've talked about that here before, where I'm going to give it a name now. I'm going to call it the inverse mullet, because in the shorter term expiries, the traders are still partying. They're still selling puts. They're still selling covered calls. And you can see it's extremely steep from short-term expiries then you have the election hump, but then after that it smooths out and it's pretty steady. So it's business as usual, or investors still think there's concerns 1 and 2 years out. So I call it party in the front, business in the back. There's your inverse mullet. Looking at relative vols right now, we're seeing relative to the SPX, technology, Nasdaq, and gold a little bit expensive to the SPX, and conversely, emerging markets, EEM, a little bit on the cheap side relative to the SPX.
The folks at Thompson Capital Management may be taking issue with that mullet use case there, Chris. Have you listened to our Volatility Views program? Because they like to look at and view the VIX term structure in terms of mullet, and they call it the TELLUM, which is the reverse mullet.
All right. Well, I didn't know that, so I'm not trying to steal anybody's thunder.
You guys may have some copyright battles on your hands. I'll leave that to the lawyers to sort out as we move on into our final contributor here. He's on vacation, but beaming in. Mr. Eric, obviously we're coming hot off the heels of the busiest and the third busiest months of all time from an options perspective in terms of June and July. August also on pace to be an interesting month, I think, to say the least. What has been catching your eye and lighting up your tape from a market's perspective and indeed from an advisor perspective since last we chatted, sir?
Well, I'm going to say, listen, Mr. Hausman was very creative. The party in the front and the business in the back is something that I hope to use just in my normal day of conversation with people. I think that's wonderful. But Mark, you alluded to it. Look, we've had historical volumes in June and July for the OCC. 48 years now that the Options Clearing Corporation has been clearing, and what I find very fascinating as well with Matt talking about some of the earnings, and I'm hearing this a lot from advisors, Mark, is that you're seeing people at home and the retail client. Obviously, you mentioned Robinhood and other self-directed firms, that more and more retail individuals are finding that they're interested in learning about option strategies. That in turn is increasing calls to the Option Industry Council, as well as advisors, Mark, who are calling and reaching out to us and to me, because you're talking about this election as, Chris talked just a couple minutes ago, and then what's going on with the economy, what's going on potentially with some stimulus. And advisors are trying to be proactive, not reactive, and talking to their clients about strategies. One of the things I'm hearing more about in August, Mark, and maybe Chris will, mention, his firm, and if they're fielding questions, but advisors are calling more and asking about collaring, maybe doing a zero cost collar, but also maybe attaching a put spread to that as well. But they're trying to see, how do we participate this upside and maybe protect some of the downside. So that's something that we're hearing more about. And then again, advisors, trying to learn a little bit more about some of the defensive strategies relative to this election. I mean, I think that there's a lot of unknowns going on right now, and with advisors not meeting with clients in their offices, they have to be much more attentive.
I can't say I'm surprised to hear that collars and generally defensive strategies are dominating the tape in the advisor space. I think you'd be not exactly doing your due diligence out there if you weren't considering such strategies, given the fact that we've had the mother of all V-shaped recoveries out. I think it was on this show back in the beginning of the year, February, March timeframe, where we were selling off. I think it was Chris, a.k.a. the director of risk, who said back then, if we rally back to unch from here, this would be the mother of all V-shaped recoveries. Well, spoiler alert, listeners, we did pretty much exactly that, and we are sitting there now. So if you're sitting on hopefully you're sitting on some gains, and if not, you're at least looking at lofty valuation levels. If you're thinking about getting in, hopefully at the very least you got some protection in mind. If you don't know what we're talking about there, check out the archives of this program. We spent a lot of time talking about how to protect your portfolios in such environments. Speaking of protecting your portfolios against blowing up, Eric, I know this one kind of came across your radar over here as well, the folks at Fox Business talking to your old friend, Mr. Director of Risk, our friend as well, Mr. Tony Saliba, now hanging out over there at the Matrix Group, kind of breaking down just some kind of basic options nomenclature and basic options use cases to avoid kind of blowing out your portfolio out there. So the folks at Fox Business at least trying to dip their toes from a very basic perspective. I'm not sure how they got to Tony on this. It's an interesting mix out here. But Eric, I know this one came across your radar. What are your thoughts on the folks over there at Fox Business advocating against blowing out using options, sir?
Well, it's interesting, and kudos to Tony for sharing some of his insights about education, and that relative to dipping your toe in the pool, that advisors and as well their clients need to know about the risk and reward. And, Tony talks a little bit about, selling naked short, options and infinite amounts of risk. And they have to understand the nuances, which again, Mark, a shout out to your show for so many years has been doing that, has said to individuals, institutions and advisors that, this is just not something you go at blindly. I mean, you have to understand sort of the makeup, and that there are ways to kind of, maybe start with a conservative, as we'd like to say, maybe start off with some of the, the strategies of selling calls and protective puts. And then as you start to get a little bit more comfortable, from that vantage point, you can then ramp up a little bit of your trading acumen. But, look, the fact of the matter is, Mark, there are more and more individuals, as you would like to say, beginners getting into this arena, which is why the four of us are here and why this show. I mean, there are opportunities, in utilizing option strategies, but, investors just sort of need to understand, more of the nuances of it. It just takes some time. That's really what it is. And I think this pandemic, as we've all said, the four of us over the last 6 or so months, that there's been an explosion from the retail side because you've seen what's gone on in the market since the end of March. And I guess this V-shaped recovery. And now, people are saying, look, there's ways to capitalize maybe and find some other opportunities out there rather than just saying go long delta, that maybe there's some ways that I could, integrate different strategies in my portfolio. And individual investors are finding it to be exciting, I guess.
Yeah, it seems like it. I think we have a listener question a little bit later about all those beginners piling into the market, a.k.a. through the lens of Robinhood. We'll get to that in a little bit. But first, Mr. Chris, I know you spent some time with Mr. Tony over there in the options educational trenches. What do you think about his viewpoints here and also just his article in general about advocating for the use of options to do exactly what we talk about on the show all the time, prevent that portfolio blow-up, sir?
Yeah, I had the privilege of working with Tony for many, many years. And, while I was on the trading desk there with him, I tended to lean short vol. He's always been a long vol trader. But at the end of the day, it's really about net units. And you've heard that phrase here many, many times. You can still construct short volatility positions as long as you're not net short units, because that's where that risk really kicks in on the net short volatility side. So, right now is a great time to look at insurance policies via the options market. People have made some tremendous gains, especially if you were fortunate enough to buy during this dip when the markets were down 20, 25, 30%. So now is a really good time to, and again, going back to that term structure, people are hedging out there. They are looking beyond the elections. They are looking at, at some point, something's going to give. Either the stock market's going to give or this economy is going to catch up to the stock market. So we just don't know which one is going to happen right now. So again, at the end of the day, you've got to manage your risk. Short vol, it does have risk, but you have to be able to look at tools and be able to pull that risk off or always remain, at least don't be net short units, be net long units so that you can survive these fat tail events.
Funny, I can just envision you and Tony fighting on the trading desk over short vol versus long vol. Fun mental picture for me there, Mr. Director of Risk. But now, speaking of mental pictures, you don't need to actually draw one. We got it all broken down for you over there, theoptionsinsider.com, courtesy of Matt and his magical earnings analysis machine. You get the earnings move results, and indeed now a new kicker, the earnings season reports. And it's that latter that we turn to now, Mr. Matt, because as you mentioned on our other show earlier, which actually was earlier this month, due to some rejiggering due to the hurricane, so not that long ago. But still, as you mentioned on our last show there, Mr. Matt, it was effectively a blood red season for options premium buyers. What are you seeing, sir? Is that continuing out there on the earnings front? Is there still blood in the waters for option buyers, sir?
The worst I've seen, Mark. No.
Isn't that crazy? Just think about that for a second. We're still in the middle of a pandemic. We have civil unrest, global all these other things, and yet buying vol is a loser, at least from an earnings perspective. Isn't that crazy?
Well, yeah, and what happened a lot too is the implied earnings move got to levels that made it very difficult for the owners of options to really make money. And of course, just like in any earnings season, you're going to have outliers. Apple outperformed. Cisco was down, but the owners made money. But wow, for the most part, I look at our results and sometimes tweet them out. You could look at Option Rats on Twitter, and they are almost always in the red, meaning that the move is smaller than the straddle and the adjusted straddle that we do. Has predicted for that particular move, and just to recap how we do that, there's a front month straddle and there's various days to expiration still, and what you do is you take that straddle price and then you try to figure out what is going to be left of that straddle price after the earnings are announced. And that net amount is the move, and that's how you get the move. And the hard part is to figure out what that straddle is going to look like. The way we do that is we looked at thousands of earnings moves and took the distribution of that and priced a straddle on that distribution after expiration. I know it's a little bit complex, but I just wanted to point that out. It's not just taking the straddle price. So just keep that in mind. And so, what we do is we identify what that move is implied by the straddles. And then we look at what the move actually was. And usually you'll see right around even, meaning the option buyers and sellers. I mean, the markets are so good that they get very close. And just because of the nature of the moves, the win rate is usually around 40%. So meaning if you're long straddles, you're going to win 40% of the time. The reason it's not 50-50 is because obviously you can make a lot more if it moves a lot more. So that's typically what we see. This earnings season, and again, earnings season every quarter, mid-January, April, July. This was the July starting one, and October will be the last one. Runs for about 6 weeks when you get about 97% of firms reporting. Well, this season, I mentioned the win percent usually around 40. It was only 26%. So 26% versus 40. That was bad. And the actual divided by implied, which is usually right around 100%, was only 76%. So that is the worst number that we've seen in any of the earnings seasons since we've calculated even historically. So that was really bad. The implied earnings moves were much higher than usual. That led to it. But again, the actual earnings moves, didn't get up even to some of the later ones when they started taking it down a little bit. So, again, I'm not as well versed about the fundamentals to tell why this was so bad, other than just that they priced it up, they didn't get it down fast enough, and so that's the earnings season. Now, there are still some earnings reporting. Of course, we put out the reports on a daily basis. There are still some recognizable stocks, Gaps, Marble, Hewlett Packard, but by and large, most of them have reported. Let's see. Yesterday, we had a huge move in CRM. That's Salesforce, and the closing stock price was $216. They were expecting an earn move of 5%. Well, they got 27%. Stock's now at $274. So incredibly up about $60 in a $216 stock. So you still see one of these, and as we've talked about just the earnings season in general, is that later on is when it gets a little bit more profitable for the owners of options. And has that trend continued this time? Yeah, it has, but still the best week was week 5. And that's about what we've seen historically. So, Mark, really, really tough for option owners, and kind of a head scratcher, really. But are people not looking at individual earnings reports? I don't know what it is. Hopefully, someone has a theory as to why this is happening. But that's the way it went, Mark.
It doesn't matter, Matt. All you have to do is announce a 5-for-1 stock split, right? And you're good to go for the next month or two. Your stock is off to the races. Yeah, these are, we've said it before, these are strange times we're living in where no guidance, zero guidance, retracting guidance, even negative guidance doesn't seem to amount to a whole heck of a lot of volatility for any of these names out there, which is fascinating. Speaking of volatility, been a lot of developments on the vol product front in particular. That's unusual. We usually don't see that much going on in the vol product space in the span of a couple of weeks, yet it's been a hot couple of weeks. First off, CBOE diving back into the VIX well again with the launch of a new mini VIX futures contract. I went deep on this with Ariane Cricky from the CBOE herself yesterday. Check out our interview program if you want more details on this and discussing whether this was a plan or whether this is a response to the massive resurgence of retail trading we've seen since the pandemic began. But this product doing pretty decent paper so far, kicked off 127,000 contracts during its first trading week. Now remember, that's a 1/10 size contract, so scale that down a little bit, 12,700 on the big boy out there, but still decent paper for a new contract out there, particularly in a period where VIX futures aren't exactly blowing the doors off from a volume perspective. If that wasn't enough, if a new VIX wasn't enough to light your candle and get you excited out there, we got a new player diving into the volatility space, and it's not CBOE, it's Nasdaq and CME kind of joining forces like Voltron here to launch the VolQ, which is the Nasdaq 100 Volatility Index. If you've been listening to this network for any length of time, particularly our Volatility Views program, you know that Scott Nations and his Nation Shares entity have been working on this product that's effectively VIX without the skew component for a number of years, over 5 years. It started. I first became aware of it back in the ISE had a deal with Scott to license this, and then it moved on. Obviously, Nasdaq acquired ISE, and now Nasdaq working with CME and switching it from the S&P 500 to the Nasdaq and launching what is effectively a VIX of the Nasdaq without any of the skew components, which is kind of interesting. So a lot to unpack. Chris, this has kind of been a surprisingly hot and heavy couple of weeks on the large and small volatility product front. What are your thoughts here on these two new offerings in the vol space, sir?
No, I think it's pretty good because I've always kind of been more of a proponent of looking at, what is pure vol, and that's your at the money straddle, and that's what we talked about a little bit earlier on the show. So these, again, I'm kind of an old schooler where I like the old VIX on the OEX, which was a little bit more compact and around the at the money, and that's really telling me what volatility is. There are other tools you can use to see where skew is or to see what the tails are trading, right, kurtosis and all that kind of stuff. So, for me, the VIX just has a lot of noise, the way it's constructed, the way it prices in a bunch of options that are nickel bid at 25 cents. I think that provides noise and sometimes doesn't give us a pure feel of what the at-the-money volatility is. So again, these are just more tools to use in the toolbox, and I think it's a good thing.
Yeah, I believe on our last program we referred to those other elements of the VIX calculation as skew and kurtosis garbage. So I think you and Scott are of the same minds on that, and certainly a lot of the lawsuits around the VIX of late would probably agree with you. They've mostly been suing based on how that skew is priced in and perhaps used in interesting ways around settlement time. Eric, I know you keep an eye on this space as well, and new products are always a welcome thing, not just for the small retail traders, but CBOE in particular, saying with their launch of these mini VIX futures that kind of the advisor and asset manager space, particularly CTAs and others on that realm who obviously are comfortable using futures and want maybe a little bit smaller contract to be a little bit more nuanced. In fact, they're also targeting prop firms and institutional investors who they like a small bite size. Look at the success of the E-mini. Sometimes it's a little bit more nuanced to get what you want done with a smaller bite size type contract. So, Eric, what are your thoughts on these two new additions to the vol space just in the last couple of weeks, sir?
Yeah, I think it's a byproduct, and Matt and Chris would probably agree, a byproduct of what happens from the constituents, back to the exchanges. Mark, the four of us can go back to, mini option contracts. Sometimes you have some good ideas, and other times ideas are introduced and they don't always work as well. I think that the VolQ probably something that'll appeal more on the institutional side, and there's discussions about this index offering options as well at some point. Mark, you were interviewing the folks at MIAX when the Spikes Index was launched, and I think the landscape having more of these indices as well as more products is really something that is kind of exciting. And it's just, I think it's paramount of the industry, meaning the exchanges that I represent, as well as the clearing firm, listening to what's going on and trying to evolve, as we are, slowly approaching in the next couple of years, since 1973, here we are almost close to 50 years, that we've had, options trading on listed options trading on exchanges. So I would say that, it's an exciting time with all that's going on.
That's scary when you put it like that. It's been almost 50 years, but you're right. It doesn't seem like that long ago. I was at the 40th anniversary party of the CBOE, and now we're closing in on 50. Time flies when you're in a pandemic over here. Speaking of interesting things and maybe some shakeouts going on in different product categories, Eric, I know you pay keen attention to the ETF side of the space as well. Of course, that's always a key driver for options volume. Product like SPY and others are obviously very popular options products out there, but it's been a little bit of a tumult, I think it's fair to say, in the ETF space. 188 ETFs have closed this year. That's a record. And new launches of ETFs are at their lowest since 2013. Even some big firms like BlackRock and others, the iShares, JP Morgan, et cetera, getting out of the game. Of course, we talked recently, they weren't ETFs, they were ETNs, but of course, Credit Suisse getting out of the TVIX game and those related types of products out there. So a lot of big names have been exiting this space of late. I know this is near and dear to you over there, Eric. What are your thoughts on effectively a bit of an exodus from the ETF space, given everything we've seen out there so far in 2020, sir?
Well, that's true, Mark. And one of the things is that they just celebrated, in March of this year up in Canada, the launch of the first ETF, which did actually take place with our brothers or our brethren up north, the folks up there at TMX. So, you're looking at the environment here in the U.S. where I want to say it's somewhere over $6 trillion in terms of what's going on in the exchange-traded fund area. A lot more of the sub-advisors and asset managers are looking at ways to offer solutions to advisors. So even though there have been news about these closures, there have been collaborative launches going on in the ETF space where you're seeing, certain firms that I know that you've had on your show, Mark, before, and others that are in the derivative space who are now sort of collaborating with bigger firms and offering, I would say, in, the last, couple of years and even in the past, 6 months, these defined outcome funds, which, there's been Mark, we talked about it with Chris and Matt, about the structured product, parabolic growth that's gone on at these firms. Well, now these ETF providers are offering these solutions on sort of a monthly basis. I mean, I go back to the days when I actually had a mullet. I'm glad that Chris brought that up because I actually did have hair at one point in my life. But when I was an advisor at a large firm, I was offering, solutions, and one of those being UITs, where you used to buy the dogs of the Dow and you offered these dividend solutions to clients. So it's exciting to see some of these firms that are getting into this space and offering an overlay solution, because there are still many advisors that are, kind of on the fence, Mark, right now with wanting to offer these solutions. And I think this defined outcome strategy where, you're seeing it from, say, some of the firms like, Innovator Shares or First Trust or others, where advisors can actually hire somebody and offer the strategy to their clients.
Matt, same question for you, sir. I know you pay attention to this space. It's probably one of the key data sets you guys are analyzing in the ever-growing analysis machine that is ORATS over there. What are your thoughts on these increasing shakeups in the ETF space, sir, and maybe what that means from an options point of view, sir?
Well, this is really interesting to me, Mark, because some of these ETF providers that you mentioned are clients of ours, and they come to us and, trying to talk about the importance of their ETF. So I think it's really interesting that the ETF providers are now coming to us for data to show things like, is the tail wagging the dog? Is the ETF leading the rest of the individual stocks in volatility and implied volatility preceding historical moves? And one of the things that we do at ORATS is we have, for many of the ETFs, is we go get all the components and the weighted components. So we're able to show what the weighted implied volatility average is for many of these ETFs, and then then what the ETF providers are doing is they're overlaying that with the ETF itself and what is moving first in actual volatility. So that's been really interesting. If you go to ORATS, it's like XLK_C. that gives you a graph of the components and all the implied volatilities. And that's what has been of interest, especially for these ETF providers coming to ORATs and trying to make a case for their ETFs, Mark.
I knew you'd always have some great data at hand. Now we have time for some great questions. Our mailbag is quite literally overflowing out there these days. So let's see how many of you we can squeeze on the show with a special office hours extravaganza.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, welcome to the office hours. This is the portion of the show where you guys take the reins, your questions, your comments. Before we get to that, we got a bit of a little live Twitter beef brewing here, courtesy of our producers who may or may not be egging it on behind the scenes. Of course, Mr. Hausman, with his great description of the VIX futures term structure as the mullet, business in the front, party in the back. Of course, the Thompson twins like to use that trading strategy quite a bit, the mullet and TELLUM. So picking a little bit of a fight with them on Twitter, noting that Director of Risk may have been stepping in on their territory. They replied during the show here, as you do on Twitter, with a GIF. This time of, it looks like, I'm blanking on his name. He sings that Achy Breaky Heart, so I'm blanking on his name right now. But he used to have a mullet, a picture of him when he had a mullet, and the tagline for the GIF is, "The mullet is a symbol of power." So, Mr. Chris, Director of Risk, the ball is in your court, sir. What say you to these folks who are fighting back at you of ownership of the VIX mullet / TELLUM, sir?
I will gladly bow out. If someone needs to fight over a mullet, you can have it.
A spirited response. We'll make sure to quote that. Just how funny is it that there are two people playing in the VIX mullet and TELLUM game out there? Speaking of the game, what we were talking about on our last episode also got a lot of people's knickers in a twist. We were talking about, I think it was a listener question we had. Yeah, it was. It was from, blanket here. This came from Neth. He wanted to know about the Series 7 and whether it was really, he thought it looked kind of limited from an options perspective, and he thought, what are your thoughts on the options component? We discussed it at length a bit on the last show. A lot of listeners had thoughts they wanted to add to our conversation. We just pulled a few here. Scott chiming in saying the Series 7 is basically worthless regardless of what your investment philosophy is and what strategies you use to implement it. So not really pulling any punches there, Scott. Got another Scott. This one is Scott Stewart chiming in. Said, I would submit that the Series 7 never was relevant for options traders. Says he passed his exam in 1987, early days over there, at least from an options perspective, and learned absolutely nothing, in all caps, about trading from it. Yeah, that's kind of our takeaway as well. These exams, unfortunately, tend to focus more on the regulatory side. Regulators design these exams, and they don't want you infringing upon regulations. That's what their chief concern is. Not on your efficacy when it comes to trading and managing money, which you would think from the surface would be the focal point of an exam like that. I want to get your guys' thoughts on this. We've got some other related questions on this. I'm going to throw these in as well. First off, we got a question from Dorian along a similar vein. He says, love the network, and I found the debate on your advisor's option show regarding the Series 7 particularly interesting. I've toyed with taking that exam in the past, but bounced off for many of the same reasons described by the hosts. Are there any licenses out there right now that you feel hold particular value for options traders and fund managers? And then Melt D also chimed in saying, regarding our Series 7 comment, saying, I have the same thoughts about the CFA exam. He thinks that's a useless one as well. So a lot to unpack here. Let's go around the horn. Let's go the way we just came before. Let's start with Mr. Eric. I know you've had a few licenses in your days. What are your thoughts here on our listeners chiming in, effectively piling on, all just crapping all over the Series 7 when it comes to its use case for options? And also, I think for you in particular, this question is kind of interesting. Are there other exams out there? I know it wasn't an official exam, but you used to have your option certification you guys used to do over there at OIC. So A, do you guys still do that? And B, do you have any other suggestions here for Dorian, who wants to know, are there any licenses out there that you think are particularly useful for options traders and fund managers?
It's a good question. I mean, I think everybody's got their own opinion. And look, I took my Series 7 and 63s and all that many, many, many years ago. And, I think I talked about it the last time we were on this show. I was a fixed income guy. I was a municipal guy. And then I got into the buy side and private client side. And, so it was interesting because the majority of that exam was really made up of tax-exempt securities and derivatives, mainly options. And your point, Mark, well taken, that it was sort of fundamental knowledge that you didn't necessarily implement. And I've really always said this, one of the obstacles with advisors is that they had such a bad taste in their mouth from taking a Series 7 with learning the options component just to pass it, that they didn't really want to focus on it when they became a investment advisor. And you're seeing more of the, say, brokers going into this registered investment advisor sort of role, that not all of them are Series 7 licensed anymore. And I just want to touch on the CFA for a second, and then I'll turn it back to you so Matt, and Chris can weigh in. But you're seeing a lot more of the family offices and sort of these bigger wealth management practices, Mark, have a CFA certified person, that's a certified financial analyst, who is on that team, because these are more of the individuals that have like sort of a sell side background, but also, the quantitative knowledge, that they're more of the PM, overseeing the assets and the day-to-day management of the entire portfolio. When you kind of look at a different role of an advisor, it encompasses a lot more, which is really planning for, your client's succession and their retirement and educational planning and all those other things. So that doesn't really fall within the Series 7, and maybe it should, but, look, everybody's got a different opinion. It's just sort of the way the regulations work within, with the SEC and, how they regulate. But I do know that we all did talk about this. They did revamp the Series 7 a few years back. So I know there are more, there's more regulatory and there's different components to it.
Mr. Matt, same question for you. Anything you want to add here on our myriad of questions and comments regarding the Series 7? Clearly, we hit a nerve with this one, sir.
Well, so my background is I went out to Chicago, went to graduate school, and then got my CPA, since I was in a CPA firm that analyzed the valuations on various trading firms. And then so that was worthless. But then I took the CFA, the first test, and passed it, and I said I couldn't do anymore. But the CFA, I thought, was a pretty good test for the finance majors. I mean, it's got corporate finance, economics, financial reporting, some quant, some derivatives. But then I went to the floor of the CBOE. And I hired and backed a bunch of people there. And I always liked the people that I could train myself. Like Tony Saliba, I was backing them, so I wanted them to belong. So we did a lot of our own training. And, I found that some of the other groups, did a decent job, but really to really respect the market and to understand, like Chris said, units and where edge comes from, et cetera. And then also, making proprietary, where is your edge coming from is always what I'd like to teach. I saw in the CBOE, they have a class or an online class that looked pretty good. Of course, the OIC has a bunch of stuff as well. So, that's what I'd recommend. Learn it yourself, have a good respect for the market, listen to this show and some other option bootcamp shows, and that's the way to do it, Mark.
Yeah, unfortunately, it's on your own shoulders these days. I know there was some talk. I used to push for a long time in the early days of the Options Insider for the options industry to get together and try to offer some sort of option certification, a shingle that the advisor or the asset manager could hang out, because they like those things to hang on their wall. It's a marketing tool for them. And also it would ensure that they actually know what the heck they're talking about, prevent some of these blowouts out there. And it seemed like there was some movement towards that. Then our friend, Mr. Bernie Madoff, came along and it seemed like he really put the kibosh on anyone being willing from a legal sense or regulatory sense to certify anyone, because God forbid you certify a Madoff and he blows out people to the tune of billions of dollars. So that seemed like that kind of brought that to a rapid conclusion. But so unfortunately, I don't think we're going to be seeing any more of those anytime soon here. What was the listener's name here? Dorian. But still, it's an interesting idea. And unfortunately, you got shows like this. You got networks like ours. You got folks like the OIC and others who will reach out to you. You used to have the 10th box events from SWAN. Hopefully, they'll be coming back soon. So you have a lot of resources out there. Just no official exam certification / single you could really hang on your wall that is purely options and derivatives focused out there. All right, let's go on out to Arkham ST. Maybe he's a Batman fan. I don't know. I'm gonna call him Arkhamist. That sounds cool. Arkhamist wants to know, what are your thoughts on the volatility bump around the election now? I know earlier in the year, your contributors, including Matt, Mr. Oracle of New Hampshire, you've been named here, including Matt, viewed this as a screaming sale. Is this still the case? I believe he's referring, Mr. Matt and our listeners, to our conversations earlier this year, prior to the pandemic and the onset of all this madness, where we looked down the road a bit. It seemed very distant at the time, to the latter portion of the VIX futures term. VIX futures all over the show today for some reason. The latter portion of the VIX futures term structure, and saw this very pronounced bump right around the election. And we discussed at the time whether that was warranted or not. And of course, fast forward till now, a lot has happened in the intervening months to drive a lot of other volatility in the marketplace. But Mr. Matt, you are named in this question, so we'll start with you. What are your thoughts on this quote unquote volatility bump, as he terms it? And do you think it's still overblown, sir?
It remains to be seen. But what I was seeing before was, the bump, and then, November was a lot lower than October. Of course, October futures, since they are futures, they encompass the election. But now what's happened is the bump is actually kind of more pronounced, but it's tilted. The front month VIX is about 25, and it's about 30 in the October still. So it's still staying there. I think it's over. It seems a little high to me. But now what you're seeing is November coming up, and also December for that matter. So, what I was thinking was a type of a butterfly where you buy the wings and sell the middle. Definitely November's come up, but the October is still staying there. So that's what I'm seeing in market. And just one more thing. One of the things that we do as well is we're treating the election as an earnings for the SPY, and it's about a 3% still, 3% move in the underlying market around the I was going to say earnings announcement, but the election announcement. So it's kind of fun to treat that as an earnings event for the overall market. But that's what we're checking out. And that's been relatively constant, Mark.
I like that. Earnings event for SPY. It certainly can be put in those terms. Chris, I know in addition to your mullets and TELLUMs, you like to analyze this election vol we've got going on right now. What do you have to say here for our listener, Arkhamist, who wants to know if you think this is still a screaming sale, this election volatility bump, sir?
Well, something's going to give here. The order flow has definitely been sell front months to fund longer-term hedges after the election, because the risk was who's going to be president to are we even going to have a president on November 3rd? And are we even going to have a president January 1st of 2021 now? So the risk continues to extend here. But at some point, this inverse mullet is going to normalize and look more like a flat top at some point.
You had to twist the knife, didn't you? You had to throw the mullet. The mullet back in there, sir. All right, we got time. Let's see. We're coming up against it, but get so many great questions. Let's see if we can squeeze on at least one more. Let's go to Dustin. It's got a very straightforward but a very useful question. Dustin wants to know, what is the easiest way to find an advisor who uses options? Thanks. We've touched on this on the show in the past. It's not as easy as you might think. There are some databases out there, but when you start trying to select and choose different asset classes that your advisor may manage. It's very difficult to drill down into options. Let's say you want covered calls on equities. It's kind of hard. You can't really get that. Maybe you can get alts. Some allow you to check alts. Some will allow you maybe to have a deep drop down that is options, but not all the time. Eric, I know you're versed on the many different tools and databases and things out there. You guys also do the studies all the time from Cerulli and others about what's going on from the advisors and use case of options perspective. What do you have to say here for Dustin? He wants to know, how do I find an advisor who uses options?
Well, Dustin, you have one on this call right now. You could go to SWAN Global. That's one of the places you could go. That's a shout out to my colleagues down in Puerto Rico. But, there are places. First of all, I would absolutely recognize the investor services group at OIC. That's the 888 options, because we do get a lot of calls from advisors around the country that ask about, places they could find advisors that are offering strategies, or advisors who, are, kind of working at a firm that might be, offering some of these solutions. So also, Mark, that one of the things that we do a lot of, we host events not only at OIC, but we host events with advisors, because we have an advisor leadership council that's made up of option-centric advisors. And then also we have a ton of online material, whether it's webinars or podcasts, that give advisors an opportunity to learn, as well as retail investors. There isn't per se an area that just kind of designates out advisors that are truly option-centric. But, look, there are places, certain firms actually, whether it's registered investment advisors or some of these regional firms, do profile, I guess, their option-centric advisors that are doing more of these strategies on a regular basis.
All right. Unfortunately, that music means we've come to the end of another epic journey through the world of options. Man, we covered a lot of different topics here on the show today. The VIX mullet / TELLUM, don't think we've heard the end of that. The election bump that is being priced in. Matt currently puts it at around 3%. I like that perspective of an earnings event for SPY out there. We talked about new volatility products coming into the space, some of the use cases for options. So if you don't want to blow out your portfolio, maybe how not to go, and also how to go. What's going on? I'm talking about bloodbaths from options, volatility, and premium buyers during earnings season. Will that continue? We'll keep an eye on that. And, of course, the big shakeout going on in ETFs and a bunch of your questions as well. You guys have Series 7 on the brain. I don't think we've heard the end of that one as well. But before we go, let's go back around the horn. Let's start with the Director of Risk. Mr. Director of Risk, sir, I want to reach out to you about VIX mullets or TELLUMs, or maybe I want to check out what you guys have cooking in the land of SWAN. Where should I go? What should I do, sir?
And don't forget flat tops now. I'm going to take that one.
Flat tops. So, okay, that's yours. I think you have that one.
There you go. Thank you. We're real busy right now with overlay solutions. It's been great. I mean, people are looking to hedge out existing portfolios, as well as stock replacement strategies, where people do want to get rid of their underlying, but they still want some skin in the game to the upside. So we continue to have a lot of great content over at swanglobalinvestments.com. So check us out.
There you go. swanglobalinvestments.com is the place to go. Great content. Got newsletters over there, great articles, research, white papers, and even links to a cool little show called The Advisor's Option. A great place to go and hang your hat in between episodes of this program. And Mr. Cott, you guys have a lot of content cooking over there in the land of OIC, including maybe some interesting courses folks might want to check out over there at OIC. So what do you have to offer for our listeners here, sir?
Thank you, Mark. And I just wanted to say really briefly that although there's not the certification that you've been talking about for years, one of the things that we're building out currently at the Options Industry Council is a LMS, a learning management system. So I encourage your listeners to go to optionseducation.org. They could take a look at that. We are building out a lot of content on there, and it really is an exciting platform that for a lot of folks that are now at home during the pandemic, this is something that they can get involved with. The other thing I'll mention is that OIC and the OCC are having a webinar on September 15th at 3:30 Central Time, which will be an exclusive event, the state of the option industry. All of us know our good friend Henry Schwartz, who's going to be on there kind of talking about what's going on in the industry, potentially some record volumes by the end of this year. So I encourage everybody to sign up for that.
Check it out. You know where to go. Optionseducation.org is the place to go to begin your journey. And last but certainly not least, Mr. Matt, we crunch a lot of numbers on the show today. We talked about a lot of earnings, the bloodbath that's going on out there. If folks want to crunch the numbers for themselves, maybe they want to run a few back tests, maybe they want to pick your brain about a certain strategy they're looking at in the option space, where should they go? What should they do, sir?
Come on over to orats.com. I'm Matt at orats.com. We've got some really, I think, unbelievable stuff. Our development team's been working hard. We have a way to backtest strategies and then scan for them and then sort those output by a distribution percentage. So if the stock would move like it moved in the past, how much return would you make? We also have a risk parameter in there. Chris and I were talking about that before. What's the most you could lose over a 3 standard deviation, 2 standard deviation amount? It's really cool. Cost per delta. There's just some really neat numbers our users are looking at when they're weighing which strategy to do. And we also are working on an execution device where it kind of legs into spreads. So, it's a lot going on. Really fun, and look forward to hearing from the advisors, the crew.
There you go. Check it out for yourselves. Orats.com, ORATS.com is the place to go. Give them a follow on the old Twitters while you're at it, at OptionRats. A very memorable handle, always tweeting out some interesting data in between episodes of this fine program. And on behalf of Mr. Matt, Mr. Director of Risk, and everybody over there in Swan Land, and of course Mr. Eric and everybody over there at the OIC, and indeed myself, I thank all of you out there for downloading, streaming, subscribing, for literally bombarding us with so many great questions. Keep them coming. Maybe we'll do an all questions asked episode next time. We've got so many of them, so stay tuned for that. Stay safe out there, of course, and if you want more in your ear holes, you're listening live, just stay tuned. We'll be back in a few minutes with everyone's favorite out there these days, Options Bootcamp. Going to break down options from a great basic perspective, coming hot off the heels of our 100th episode spectacular. What do we have in store for you? Well, stay tuned to find out. If you're listening, of course, after the fact, just hit next on your podcast device of choice. You'll get it queued up there, and we'll see you back here really soon for the next episode of The Advisor's Option.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.